I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Neil Dutta on the line, and he is head of U.S. economics for Renaissance Macro Research. He leads their economic research efforts, analyzing global trends and cross-market investment themes. Neil, how you doing today?
I'm doing great. How are you?
Good, good. Could you just give us a little bit of your background, your education, and your background in the markets, and how you ended up with Renaissance Macro Research?
Well, sure. I spent the first part of my career at Merrill Lynch. I was there for about 8 years, and got my start actually under David Rosenberg, a well-known economist across Wall Street and Bay Street, which is Canada's version of Wall Street, and then later under Ethan Harris, and then a couple of years ago I got a call from Jeff DeGraff, one of the top-ranked market technicians on the street, who asked if I would be interested in joining his firm to lead their economics effort, and the rest is history. In terms of my education, bachelor's from NYU in economics, and then my graduate coursework at Fordham.
Okay, so what do you look at? I mean, there's a lot of different things out there to evaluate the economy. Do you have a couple, staples that you rely on and then kind of move out to other lesser indicators, or you just cover a whole broad spectrum of things?
Well, I tend to look a lot at the U.S. economy, but we also look overseas. I mean, in the U.S., clearly, all economists are going to be focusing on things like employment and retail sales. To me, those are the sort of workhorse indicators. Frankly, over the last several years, I mean, there's been a clear sort of evolution in the way economists look at the economic data. I mean, models have gotten increasingly sophisticated. People look at these things called GDP nowcasts. Basically, what you're doing there is taking all the high-frequency data, spitting it into a model, and trying to give clients a real-time update on where the economy is at that moment in time. And right now, those models are actually showing GDP growing at about 3% in the third quarter. So, considering growth in the second quarter around about 4.5%, it's a pretty respectable performance after a strong Q2.
Okay, so the GDP, looks like it's going to hold in there. Unemployment has been dropping. Now, a lot of the discussion with the unemployment rates is just that really we're really not dropping, but it's really people leaving the workforce that's actually bringing the numbers down. What's your take on that?
I think that's partially true and partially untrue. I mean, I hate to be the two-handed economist, but that's the labor force participation rate argument really is one of those classic stories. But I do think that a lot of the drop in the participation rate is purely demographic. Baby boomers retiring. And that's pushing the labor force participation rate down, and I think that's probably over half the decline in the participation rate. On the other hand, I think you're right that there is a cyclical component where people drop out of the labor force because they're discouraged about their prospects. Now, I would also argue, though, that that's beginning to change. You are seeing the discouraged worker count drop, and you are seeing payroll employment growth strengthen. We're running at 230,000 on average so far this year. And at the end of the day, I don't think anybody was really calling for that in January. there has been a clear improvement in the rate of payroll growth this year, no matter how you slice it. Whether you look at jobless claims, which we know are at cycle lows, if you look at payroll employment, we were trending between 175 to 185, 90,000, and now we've broken out to the upside. So I think it's pretty disingenuous, I think, on the part of some people to argue that there hasn't been a material improvement in labor market conditions. And so, to me, that suggests that a lot of the decline in the unemployment rate is for real. And moreover, if you look at the decline in unemployment this year, it's been almost exclusively a function of a drop in the unemployed count for those that have been out of work for at least 6 months. So we're seeing the job finding rates of the long-term unemployed improve. We're seeing the unemployment for long-term unemployed come down. And that's ultimately a good thing. I mean, the labor market has to be strengthening in a pretty significant way if we're being able to absorb workers that have been unemployed for 6 months. So I think, and this is backed up, frankly, by a lot of the data from consumer confidence. I mean, if things were so bad, why is consumer confidence even going up? We can talk about are things as good as they ought to be, but that's never a discussion that really has any material value in financial markets. What financial markets care about is, are things getting better or are they getting worse? And I think the answer to that question unambiguously is things in the U.S. at least are getting better.
Okay, so, just based on that statement, then, the sell-off in the market here over the last couple of days, do you kind of see that as kind of unjustified based on the economic data that you're analyzing?
Well, I think we were, it's interesting how sentiment moves. I mean, I think it's important to recognize that markets and economists, financial investors, and central bankers, they move on different time horizons. We've had multiple sentiment swings in the marketplace in a span of 3 to 4 months. 3 months ago, we were ridiculing Janet Yellen for going out there and calling the rise in inflation noise, and now here we are 3 months later, and we're talking about deflation risks. I mean, think about that for a second. And what's materially changed? Has the Fed outlook materially changed? I would argue that it hasn't. I think we were due for some kind of a correction. We had a very strong run in equities over the last couple of years. I think that's in part due to a catch-up after a very bad 2011. I mean, equity markets were flat that year, even though earnings were pretty strong, and we've played catch-up. And so, I think going forward, that should imply somewhat more muted gains in equities, but I think they should, equity market returns should still be positive, more reflective of underlying corporate earnings, which are still, relatively healthy. And so, GDP in the U.S. is rising. Productivity, I think, is going to begin to pick up. That's a reasonably favorable backdrop for equity market investors. And so, I think you look at the move in equities, you respect the move in equities. You look at the move in bonds, you respect the move in bonds, but I think it's difficult to at this point say that that's signaling a sort of imminent weakness in the U.S. economy.
Okay, and another huge driver, or the main driver, has been QE. The Fed has announced, that they are, stepping back, at least their bond purchases for now. They called it for to ending in October. It is coming in October. We're having other factors going on too, but that's been the driver. Now you're taking the driver away. Do you think that the market is still going to be able to continue or recover from this with the absence of quantitative easing?
Well, I mean, it's interesting. Think about what you just implied there for a second. I mean, there's a pervasive view among traders, among most financial market participants, that markets are inherently forward-looking. We've known probably for the better part of, 6 months at least, that QE would be ending in October. The Fed has been very methodical about this. So the question is, why didn't the sell-off happen in April or May or June or July or August? So I think a lot of this, I think it's a bit too cute to say that this is all a function of QE. I think there's been a clear deterioration in growth expectations overseas, and that's what's taken risk assets lower. And interestingly enough, that's what's been happening in prior episodes of market volatility. If you go back to the sell-off in 2010, now people will make the argument that it was QE that drove equity prices down. But if you actually go back to that period, equity markets were still rallying even after QE came off. It wasn't until Greek CDS blew out that equity markets in the U.S. began to come under significant pressure. In 2011, we had a debt downgrade in the U.S. We had sort of hard landing fears in China, and we had Europe as well, and also the U.S. economy was a bit softer then. I mean, I remember economists taking up the recession probabilities to 40-50%. So, I would just argue that it's not 2010 or 2011, and so I think the U.S. economy is in a considerably healthier position today.
Well, it's the U.S. economy, and I mean, you talk about the numbers showing that slow, steady improvement, but it just seems like we're the only one. I mean, eventually, isn't that going to have a real negative effect on the U.S. economy if Europe and these other economies are just mirrored? I'm now, and then just going into the second part of that. I mean, QE in Europe, what Draghi's talking about. You think that can have the same desired effect that it's had in the United States?
It's hard to know. I think the net impact of QE is definitely a lot less than people make it out to be. Not only for financial markets but also the economy. That being said, it is positive. One of the things about the U.S. I mean, this is a very hot topic. Is if weaker growth in Europe is going to spill over into the U.S. And I see a pretty small hit to growth. I mean, first, you have to look at the trade linkage, right? And the U.S. is a pretty closed economy. Exports are about 15% of GDP, and exports to Europe are just 15% of that. So you're talking about a pretty small component of U.S. growth. So all else equal, let's say exports to Europe plunge 10%. U.S. GDP would get cut by 0.2%. I mean, that's not going to materially alter anyone's baseline projections. And you can't look at all this in a vacuum. I mean, economists are often fond of saying all else equal, X happens. Well, in the real world, all else is never equal, right? So, we can talk about the strengthening dollar and weak growth overseas, but the upshot is that gas prices have come down more than 1-for-1 given the increases in the dollar. So that's going to have some positive impulse for disposable income and by extension over time consumer spending. So I would say two things. I think Europe is a negative. Clearly we'd rather be Europe growing faster than what it is. But I think that the damage to the U.S. is going to be relatively contained. The risk, of course, is what happens in financial markets. That's what really matters. If you have problem in interbank funding, if sort of LIBOR OIS spreads, interbank funding markets begin to seize up, then I would begin to worry about what it would mean for the economy. But at the moment, there's no clear signs. Actually, there's no signs of any of that happening. Market functioning in interbank lending markets, repo markets remain okay. Those spreads haven't really widened out whatsoever. So as long as that continues, this is going to be to some degree a non-event.
Okay, and this is it's kind of hard here because it seems that from just talking with you, you discuss your data, you do your research, and you have quantifiable numbers to base your predictions on, or at least look forward. But then you have something that comes totally out of the blue. The thing with Ebola. This is like the Ebola break. I mean, how, if you can, is there any way to factor that into? I mean, it's such an unknown. Do you just kind of just say, hey, I don't have statistics on this. I don't know what's going to happen. I'm just going to put that aside and just study what I know? Or, it has to be somewhat of a factor in your analysis.
Oh, without question. I mean, yeah. I mean, remember we've dealt with issues like this before. I mean, the most recent obviously is the SARS outbreak in 2003. 2003 was a pretty good year for the U.S. economy, by the way. I mean, we grew at about 4.5% that year. Not that I'm saying that's going to happen over the next year, but clearly, I mean, it's difficult to measure psychological impacts, but I mean, my own personal view is that this is probably going to be more of an issue, at least in the media. You're going to get that CNN effect, over the next couple of weeks. I think it's a very relevant and reasonable question to ask. How many more people are going to get infected? And we know that Ebola is a very deadly disease. I also know that the U.S. public health system is second to none, and the risk of outbreak is very low. To me, we're going to see. I think we're going to see a lot of headlines about this, but I think you have to keep these things in perspective. Again, the question is whether this is going to be enough to materially alter your baseline projections over the next couple of months, and I'm just not there yet.
We got to have Neil on the show more often here because we've had nothing but bad news and pessimism. I mean, with short-term traders and investors, you kind of get caught up in the moment, and it's great to talk to somebody that takes a step back, relies on their research, relies on his past historical standards to give an outlook on the market. And someone must be listening to you, Neil, because the S&P futures have just rallied like 10 points when you're on the show. So you're.
That's what economists call spurious correlation.
Okay. All right. Well, thanks a lot for coming on and give us a look at the macros. I think it's something that we don't cover enough on the show, and we certainly like to have you maybe after the next round of economic data comes out. We'd like to have you on again and see if your interpretations have changed at all.
All right, you bet. Thanks a lot.
Okay, thank you. Neil Dutta, Head of U.S. Economics for Renaissance Macro Research.